Well, as our monthly catch up with Shawn Burns, the portfolio manager of the Switzer Dividend Growth Fund. Shawn, how's the fund going?
Very good, very well, Peter, very good. It's been a very strong month. In January, the fund was up over 4%. Stronger markets, but it's good to see that the fund's participating in that, given its quality and value skew.
Of course, we should always make the point that last year was a sensational year for a company that goes looking for dividends. Why don't you just talk about that for a minute?
I think that we went after a lot of franked dividends last year. We participated in a lot of off-market buybacks, which means you sell the shares but you at a below market value, but what you get is almost full franked dividends for the whole component of the receipt. So that pushed up our franking a lot last year, and our unit holders benefited from that. I think that this year probably goes back to more normal levels. Those we're not seeing as many, nowhere near as many this year. So we'll get a more normal run rate.
And because a lot of these stocks are now more expensive because the market's done well, the percentage yield comes down as well, doesn't it?
Yes, as the market goes higher, dividends aren't climbing by the same rate, so there's yield compression going on, which isn't what people want to hear, but it's actually a challenge in this environment, low interest rates, low yields.
Yeah, and you being very conservative, you probably say you'd be happy with a 4% return plus franking credits plus any capital gain on top. I prefer to say 5 or 6, but that's a probably fair call. You aim for 4, but you might do better. But is that kind of what we'd be thinking about?
That's exactly right, Peter. Yeah, I think that we are still chasing franking. There won't be as much around this year as last year because of the lack of share market buybacks. Yeah. But we are sort of trying to keep that up as high as possible and not increase the risk in the portfolio as well. That's important that we don't just increase the yield up, increase risk of the portfolio and end up paying for it down the track.
Yeah, that's right. Okay, the year ahead, what do you reckon?
I think that we continue to grind higher as long as liquidity inflation stays benign. We will get, from time to time, we'll get issues that'll wobble the markets a bit. I think we are staying conservative, so we'll keep in contact with the market. We won't go out the risk curve and risk the fund from that point of view. We will chase dividends. Okay. Coronavirus, is that going to be an impact? It has already impacted some stocks in the fund, not that many, but there is some impact, especially in travel, casino type areas. We're watching it closely. It looks like you'd have to say that it's not going up exponentially. It's going up at a steady rate. So I suppose I'm in the camp that look for buying opportunities out of this. Okay, and reporting season has started. Have there been any sort of positive or negative signs you want to talk about? It's been a good start to its early days. For Switzer Dividend Growth Fund, there's been a couple of REITs that have reported, GPT, Dexus, both above what we're expecting slightly. You don't get too much excitement out of REITs, but they've been good, and we'll see how things pan out for the rest of the results season. Shawn, thanks for joining us. Thank you, Peter. That's Shawn Burns, the portfolio manager for the Switzer Dividend Growth Fund. Thanks for joining us.